Welcome back, everyone, to another one-on-one with Jerry Hall. Today's conversation is with Mr. Santiago Velez, a former nuclear engineer turned crypto enthusiast. As a matter of fact, after spending many years in the nuclear industry, he is now with Block Capital Corporation. They're doing some incredible things. Our conversation is going to range from Bitcoin, XRP, the future of digital finance, and the importance of computing power as it pertains to this digital asset space. Please stay until the end. I think you're really going to enjoy this. And remember, like always, like, subscribe, and leave your comments. Your comments and engagement are absolutely desired and appreciated. Let's get right to that conversation. So Santiago, I'm so grateful that you're taking the time to chat with me today. How are you in your isolation?
As best as can be with 3 kids, wife, everybody's home. So, that's the hardest part.
Sure. Are you also, obviously, I'm assuming you're also doing work from home?
Absolutely. I work from home normally anyway. So it's more that my environment's been invaded and they're getting adjusted more than I.
Oh, well, okay. Good deal. Good deal. I like that. So obviously when I reached out to you, it was really through a series of tweets and things that you would put out that my initial thought was, here's a young, intelligent, forward-thinking young man. And then I kind of started to look into you a little bit and seeing that you're with Block Digital Corporation. I looked at your LinkedIn. I would really, really, really like to hear how you came to the place that you are today. Like, obviously you came out of school, you've made some choices, you're a family man, but from a career standpoint, there was obviously a series of events that led you to where you are right now. And I'd really like to hear that story, if you wouldn't mind sharing it.
Yeah, absolutely. I appreciate the interest on it too. Like a lot of other people, I think in this space where the retail, we're not the institutional side that came from, financial background or some kind of financial discipline. We're really the people who have driven the market liquidity up to this point, and we're going to be the ones driving it going forward, I believe, for a while, still further. I think a lot of people have been waiting for kind of a big influx of money from the big institutions, but they're going to hold on, I think, as long as possible to the old systems and try to extract whatever value is left there. But for me personally, I guess I would say, I went to school for engineering. I graduated as a nuclear engineer in 2000. And I was in that industry. I was in the nuclear industry for about 20 years. So my kind of life course, I guess, getting to this point has been very, very conservative, safe. You go to school, you get a degree in a good job that you're interested in, and you start kind of building your life and your career, your family, those kind of things. And I've been very fortunate that I had the opportunity to do that. My left turn, if you will, into digital assets really started, I think, in 2016. The first, I had known about Bitcoin in the background for several years. I'm kind of one of those techie type people that's a first adopter. I'm the person that everybody in my family calls to get help with whatever new product or setup. And so I'm not intimidated by new things or complicated things. And in fact, I'm kind of drawn to them. But I was never really that interested in Bitcoin since its beginning, even though I was aware of it. And I think there were several reasons for that. So some of the narratives behind it I found troubling. But I did get very interested in digital assets when Ethereum came out. Because the idea of like the programmable money, the smart contracts, that really that changed. That was the light switch for me to see where this thing could really go going forward, was with Ethereum. And then, as you know, once you go down that rabbit hole, it really transforms your thinking, your paradigm, and you start making very different decisions about what you want to do with the rest of your life, frankly. So, at least for me, it's been great. I just put all the market volatility aside and all the pricing and the manipulation and things like that. I love this space. I think it's the most fascinating space in technology and finance. It's like this nexus of different technologies and skill sets all coming to meet and interact, and I think that's fascinating. So for me, I decided to pivot my career, honestly, to take advantage of what I see is going to be a huge change in the world. And I think what we're seeing now is just the first steps towards that. And I think it's going to be the kind of the liftoff point for the change that digital assets is going to bring. Did that kind of answer your question?
It totally answered my question. And I'll tell you, so it was like, geez, probably 3 weeks ago now. Yeah, 3 weeks ago, I had the opportunity to do exactly one of these shows with a gentleman who's a macro economist, macro investor named Raoul Pal. And here's a guy that mirrored a lot of what you just said, but he's coming from the traditional money world. A former Goldman Sachs hedge fund manager. He's a market analyst for hedge funds and sovereign wealth funds and things of this nature. Now, this space is so interesting in that it's drawing the finest minds from finance, engineering, business development, capital formation. It is getting the best and the brightest, despite those things that you talked about, volatility aside, price aside. You put those things aside, look at the human capital that's coming into this space. Look at there are countless verticals to be disrupted within this space. It is just phenomenal. And although I do agree that our market is primarily built on the backs of the retail investor today, I see that being I don't think it's going to be too long before that really starts to change, especially now that the US and its monetary policy has brought our short-term and long-term rates down to near zero.
I 100% agree with that. Yep.
You know what I mean? There has to be when all the same principles that make what I believe to make gold a really good investment, as far as a preservation of value and even upside for appreciation of value, crypto has all those things, but not 5x or 10x, but 100x, 1000x. And so when you look at risk reward ratios and things of that nature, which people who invest professionally do, the upside is so high that it can't be ignored relative to the downside. The downside to any trade is zero, right?
Absolutely.
So when you factor in those things, it's going to be amazing what's to come. I'll tell you, it is just really interesting. I've never met a nuclear engineer before. And
we don't glow. We're not radioactive.
I used to hear this term all the time, and I'm sure you've heard it a million. It's not rocket science relating to, advanced things. And when I'm thinking about anybody in the nuclear industry, I'm thinking you guys literally need to be rocket scientists.
Yeah, well, it's funny because the parallel with my professional education and in blockchain education are very similar, right? They're extremely complex subjects at first glance. They're very layered in understanding. So there's a kind of very surface level understanding, and then as you get deeper, it kind of peels away like an onion, realizations that you didn't have before. But What I'll tell your viewers is that it's achievable by anybody who wants to learn, and specifically any difficult subject always has a very steep learning curve, and it's not really a matter of being a genius or intelligent enough to traverse that curve. It's a certain amount of effort and deliberateness to persist even when it's difficult or you may not understand this. And I think that's true about blockchain. I think blockchain is so layered, it has so many facets and complexities that it can seem very intimidating, even to like professional people in finance. That it's off-putting, and that complexity it can obfuscate a lot of risk, a lot of detail that's very important. But if you persist, what happens is that when you get to the other side, you get a very broad understanding of some basic principles that underline the whole thing. In other words, it's kind of like you climb up a mountain. When you get to the top, that's when you can see the view. But it's not until you get there, it's not until you put in the work and you have your falls and you get lost a few times. But when you get to that point where you have a very broad view, you get a significant amount of clarity. And that's what's kind of happened to me in my professional career. And now in this space, is I feel you get to a point where now you can really understand fundamentals, which is something that you need to understand when you're going to be approaching it or creating an investment thesis. And
absolutely. I think I've gotten to the point now where I have a rich enough, deep enough understanding that I can actually aggregate the truth from noise. That doesn't mean I'm an expert, but I've finally, I believe, gotten to the point where I can disseminate relatively easily what's horseshit and what's real, which is a really good place, because when I started, it was all foreign. And there were times where I spent a tremendous amount of time learning about a bridge to nowhere. Seemed like I was, you know what I mean? When I got to the end, it was like, wait a second, this was a bridge to nowhere. Not to dismiss the effort, because I believe effort and perseverance are very important. And I think that's maybe all of us go through that at some point, where we're going to expend a lot of time and energy into something that is fruitless, whether it be learning about something or going down one particular path or the next. And we chalk it up to experience, learning lessons, and we move on, right? So, although I want to really have this discussion be about digital assets, there is something in the back of my mind that I have to ask you. And it was so compelling to me, and it's in a field that I cannot discern noise from truth. So I'm going to consider you an expert in the field of nuclear power. Sure. Bill Gates had a project, and working with this particular company, I forget the name of the company, they were able to make a very small nuclear reactor that could power a small village for 15, 20 years using recycled, already spent fuel. And I don't remember if it was uranium or exactly what it was. Are you familiar with that project?
Yeah, actually, there's a lot of projects like that. There's been kind of a bifurcation of the trends in nuclear power in terms of design and construction. What's basically happened is that the capital costs for nuclear power plants have just exploded. And sure. There's several reasons for that. There's been a layered kind of redundancy and safety factors that have been built in over a course of time due to various events like 3 Mile Island, Chernobyl, 9/11, and then Fukushima. These events have essentially caused the industry to spend enormous amounts of capital to build in these redundancies and safety features that are necessary for all types of events, basically what they call beyond design basis events.
Sure.
So what's that's done is that it's forced the industry to, at least with the existing fleet, to spend significant amount of money in developing these redundancies, these safety features. The opposite end of that is the concept of modularization. It's where you try to create a design at the core, which is inherently safe, and then can be mass produced in a factory and then distributed. And the idea behind modularity is to bring down those really large capital costs to a unit cost that's competitive with other forms of energy, particularly in areas where the access to infrastructure is limited, like either a natural gas pipeline or even high voltage lines. So for remote markets, it makes sense to deploy. Basically, it's kind of like a battery, a nuclear battery. You deploy it on site, and then it has a certain amount of energy for extended periods of time. The power densities in nuclear reactors are very high, so you can concentrate a lot of fuel in a very small surface area and then use it like a battery for a long period of time without a lot of supplemental infrastructure around it. So it's, Bill Gates and his foundation is very focused on kind of elevating the poorer parts of the world and the more remote parts of the world to much higher standards of living. It's one of their charters. And part of that is working on energy deployment and what kind of technologies can you deploy that are safe, environmentally sound, and can provide the energy needs to raise the standard of living. So they invested in a project, I think it was Terra, the Terawatt or Terra, something, Terra.
Yes, that sounds very familiar, something Terra.
Right, and that project, the design there was to take spent nuclear waste and then basically utilize it in a new form to then extract the energy. The problem with that is extraction of spent nuclear waste is a very capital-intensive project. It's very expensive, has a lot of complexity and risk associated with it. So, in principle, it's a good idea, but to really get to a point where it could help on a global scale would require coordination from governments, the private sector, and I think the point of his project is to show what's possible, kind of like take a leadership role, and then get buy-in from the community to deploy it, to fund it and to make it happen. So it's a worthwhile effort, and it's one of those things that it's kind of like you plant a dozen seeds in the hopes that one will spring up, and I think that it deserves looking into. But at this point in time, I personally don't think that, given the current world conditions, those kind of projects are going to see any fruits. They're not going to bear fruits for a long time to come. If you've looked at the energy markets recently, they're significantly depressed during this oil war between the Russians, the Saudis, and our own domestic production. And I think that that's going to continue unabated for some period of time, particularly as there's kind of a demand shock with the virus. So I personally think that the Russians in particular are very interested in keeping the supply as high as possible and the value as low as possible to take some market share from our own domestic production of natural gas, shale oil. And that's been their goal for a long time. And in that kind of environment, it's almost impossible for any kind of capital-intensive energy project to compete, whether it's a nuclear power plants or even some of the large-scale solar farms that have to be accompanied with electrical power storage. It's very difficult to compete. So unfortunately, one of the negative side effects of the virus is going to be this delay in kind of a deployment of better energy technologies than the more carbon intensive ones that people rely on right now.
The games people play. I'm not generally or naturally a conspiracy theorist kind of person, but with that being said, it's pretty easy to see when the Saudis, the Russians, ramping up production, even though it's really not in their best interest, really, unless you look at an agenda beyond price. If it's to eliminate competition, to turn, like, if the plan, right, was by increasing their oil production, they brought the price of oil globally down and disrupted the U.S. fracking markets, these markets that have emerged out of the basins and what sand pits and what have you in Canada, because the cost of production here in the Western Hemisphere is completely different than over there in the East. You know, it's a completely different model of, you know, and therefore, if they can bring the price low enough, they'll bankrupt these Western countries. You know what I mean?
I agree. I mean, I think many of the projects in the Permian and the Marcellus Shale, et cetera, those projects represent a lot of over leverage.
Oh, jeez.
You know, essentially they are what loose monetary policy has driven a lot of private equity and hedge funds to invest in, because it's forced people to go further out on the risk curve to compete for yield. And so in a macro environment that's amenable to that, where you have high prices, it's okay. But as soon as you have a demand shock, that whole precipice just collapses underneath, and you have a wave of bankruptcies. I've said this on Twitter before. I would not be surprised if there were bankruptcies in the 20 to 30% of the market across the board, just because the production costs are so much higher given the labor requirements and the environmental compliance requirements. You know, I've heard it said that in Saudi Arabia, you can stick a straw in the ground and oil comes out. You know, the way that oil and gas extracted in these basins is very different. There's a lot of technology involved. There's lateral drilling, there's chemicals, there's environmental compliance and labor standards. That all drives the cost of production up to, you know, anywhere between $40 to $50 a barrel.
Well, I was hearing they were able, not that I want to get caught up and go too deep into the weeds. The numbers that I was hearing is under $35 a barrel for any extended period of time, and our basin companies will just start dropping like flies because they can't service their own debt below that dollar amount. Let alone make a profit or return anything to the people who invested in them. That's not even in the conversation. I'm just talking about to keep their doors open. Well, the Saudis can rock at 12.
Right.
I mean, that is that's not a level playing field, and I'm okay with that, you know. But it's not. It used to be when you went to war, you declared war and you said why, and then they would war it out, and whoever won. There's so much of this stuff that is shadow and backstabbing. I don't know. Well, that's a whole nother show. We'll call that the conspiracy hour. But let's transition into something more positive, and that is the future of what Block Capital's got going on. Describe to me and the folks that are watching this, what is Block Capital and what are you guys bringing to this digital asset space?
Well, okay, so we, Block Digital Corporation, we're very focused on creating what we call a compute portfolio. So our basic thesis is that most of the computation that occurs in the world today is centralized, right? So you have your data centers that are deployed by large content creators, by your Amazon clouds, your Google clouds, et cetera, right? These data centers have essentially counterparty requirements, right? So if I'm Amazon Web Services, I need to ensure that I have enough compute on demand that when my clients' needs spike or rise, they're available. I also need to ensure that they are redundant, so that in the event of a storm hits my data center or the power goes out, I have enough on-site electricity to basically power up the computers and keep the business running. So these are layers of redundancy that data centers essentially have to have, by the fact that they need to maintain this customer counterparty relationship that we believe are they're not sustainable. And the reason we think they're not sustainable is because the amount of allocation towards compute continues to rise essentially at a linear level. You can only build data centers and power plants, et cetera, in a physical pace, right? It rises as much as they can deploy capital, whereas the demand for compute is rising exponentially, right? The amount of video that's being used on the internet is somewhere upwards of 80% at this point. By 2030, over 20% of GDP could be entirely in data centers, which is a staggering amount. And what that to me represents is a transition from kind of a mechanical-based society to an information-based society. We think we're in an information age, but in reality, we're still very mechanically based. If you look at even our electricity grids, the electricity grids were designed, in the early 1900s, right? And they were deployed to support a society that ran large pumps and large AC units and buildings and very large mechanical infrastructure. And they've been designed that way for over 100 years.
Right.
And what's happening now is that the local demand for mechanical work is actually on the decline. If you look at a lot of the grid demands throughout the United States, you'll actually see that the mechanical work is on the decline, but the information work is on a rise. And this trend towards digitization, the trend towards more and more information technology, and as software eats the world, I'm sure you've heard that term.
Oh, absolutely.
We're going to see, a higher reliance on data centers. And the problem is, again, it's a race between curves. It's a simple mathematics of one curve is exponential and another one is linear. So our basic thesis is that we want to use decentralization as a way to address at least some of that and be on the correct side of the curve. And the way you do that is by first eliminating your counterparty, right? So if you could provide compute almost like a commodity rather than a product to your customer, it becomes an on-demand kind of a commodity. Basically, you buy it when you need it without having to have some kind of customer relationship. So what that does is eliminates the necessity for redundancy, right? If I can just supply my compute to a market based on some digital incentive, rather than worry about having excess compute or excess electricity or any kind of redundancy, then I can obviously supply that compute at a significantly lower price than an Amazon cloud or Google Cloud, or anything like that. Because I don't need to worry about meeting the customer's demand. The blockchain or the decentralized ecosystem that I happen to be supporting, they'll take care of ensuring that there's enough redundancy. If my compute goes offline, then somebody else will just pick it up because they're properly incentivized to do so. They'll just take that load.
I totally get it, and it's a subscription killer, right? It's the on-demand, like micropayment subscription killer for compute. Now, here's the thing that I don't get, because I'm just not as smart as you.
I think you are.
Where does the compute come from? Like, is it coming from me and the excess I have on my laptop and the little bit of excess I have on my phone, and it's coming from the population, or is it coming from older centers that have been displaced from the Amazon Web Services and the Microsoft Azures and the Google Clouds, or is it a combination of all of those things?
I think it's a combination of all of those. But for the latter one, the centralized kind of legacy cloud infrastructure that's been displaced, and they've been displaced primarily because, an AWS has economies of scales that they can offer, right? So, so it'll come from all of the above. But I think in the latter case, with the centralized, let's call them CDNs or data centers, they still have a problem where they have customers that they have to meet. So to a certain point, they can give up excess capacity or unutilized compute. They can give that to the market at any given time. But at the end of the day, when their customers that they do still have need that compute, they have to shut that support off. So they don't have the same degrees of freedom as someone at home like you, who could just contribute their laptop all the time or their home computer. Now, the issue with that though is that your access to cheap electricity, as a home consumer, and available bandwidth and many of the other constraints is also limited too. So each kind of contributor to the overall compute market has its own problems that have to be addressed. So when we designed our company, the first thing we thought of was, well, how can we address these problems so that we're not stuck in the same position as a traditional data center, and yet we don't have the limitations that a home provider might have, right? So our solution is essentially to co-locate with power plants. And so that means that we would install our compute at the site where power is generated. And the main reason we do that is because if you've ever looked at your electricity bill, approximately 50% of it is transmission and distribution, and the other 50% is generation. And so right off the bat, you take 50% of the costs of production of electricity away by co-locating your compute with the providers of electricity. And that's a mutually beneficial relationship because, as I said earlier, as your society starts transitioning from a mechanical one to an information technology one, the load on the electricity provider rises because they're used to supplying electricity to a grid, an electricity grid, so that you can go run your AC. So as that demand starts diminishing slowly with conservation efforts, et cetera, then they see a lot of strain on their balance sheet. So by co-locating with them, we provide a value-added service to them, right? We're buying their electricity on site 24/7, and we are getting a benefit of buying it essentially 50% off, just as a rough estimate.
I get it. I like it.
Yeah, so that's kind of the first piece of it, and then the second half of it is being able to provide compute 24/7. So we don't expect to have to ever build over capacity. We don't ever intend to just have computers sitting there idle. We rather design systems that can support multiple ecosystems at the same time, digital asset ecosystems. So we're specifically focused on decentralized ecosystems that offer some kind of incentive, some monetary incentive that's liquid enough to convert it into either a digital asset we'd prefer to hold for a period of time, or one that is redeemable for fiat to pay the bills. Because the last time I checked, nobody accepts very many digital assets to pay, the electricity bill. So until that point, we'll support digital asset ecosystems that help us pay the bills and also help us redeem for other digital assets that we think will appreciate value over time. So from a business perspective, we're very interested in creating a compute portfolio. Right? And that as a concept, a compute portfolio is like any other financial portfolio, is diverse, right? We don't intend to put Bitcoin ASICs at cheap power plants and just run ASICs until they come out with a brand new ASIC to render all your equipment obsolete. Instead, we want to create a rig designs that can support various ecosystems, so that if any given market it becomes too volatile or no longer supported, because as you know, some of these ecosystems collapse, we can pivot our compute towards a different market. So that's kind of our overall business strategy. Does that make sense?
Well, it makes total sense. And it's very compelling and very attractive. I'll tell you, the only place that I kind of go sideways or left or right, deviate from being like right on point with you, is I have yet to find somebody who can explain to me how Bitcoin and don't, I love Bitcoin, don't get me wrong, I'm not downing anything. There's an element of the design for the system that doesn't make sense to me, and it's two things. One, the cost to maintain the system security is to me atrocious, and two, I don't see the incentives for the system once the mining rewards stop. So I'm thinking 15, 20 years down the road. I had one guy tell me, and he's a bright guy, real bright guy. He says, well, that's when they'll put in transaction fees. And I'm thinking to myself, well, the whole point of this was to be able to circumvent those things. You know what I mean?
Yeah. So, and this really gets to the root of what blockchain technology was intended to solve. Me personally, I believe that each use case for blockchain or distributed ledger technology is really trying to identify a particular counterparty, some third party, and disintermediate them.
Right.
And place them with either some kind of rule-based system, in this case, code, and then implement it so that it's fair, scalable, and transparent, right? And the problem with Bitcoin is that the first counterparty that it was intended to disintermediate were the banks, right? I mean, in the Genesis block, it was understood that it was basically a protest code against the behavior of the banks during the financial crisis. And in the original white paper, it was intended to be a peer-to-peer system. There were talks of store of value. But the reality is that the main counterparty to be eliminated were these third-party facilitators of value transfer, right? It was the fiat system that we've all come to rely and trust without really understanding the basis for it. And with the behavior of the central bank and the governments in 2008, it shook a lot of that trust in the system. And so that was, I think, the impetus for Bitcoin is, okay, we have to eliminate this counterparty and create a system where people can distribute value without needing a bank or without needing the government. The problem, though, is that even though they anticipated to some extent mining pools and the technology behind mining, I don't think they anticipated how quickly it would rise in terms of competition, right? In terms of hashing power. And I don't think they anticipated how easily things could aggregate, right? Either hashing power, it could aggregate geographically or aggregate under a particular corporate umbrella, or how much value could aggregate under particular holders, account holders, be it early adopters or whales that have purchased large amounts. And so they introduced new counterparties that are potentially as much a risk as the old ones, right? So you can either have a whale manipulate the markets, or you can have large owners of hashing power direct their hashing power to a different chain. You have these hashing wars during forks. So in general, when you're looking at digital assets, they're not immune to counterparty risks. You just have to understand who is the new counterparty and how much of a risk it is with respect to what your reward. Just like any other asset class, I think that's like the first step, is just stepping back and itemizing what you anticipate your new risks to be. And I think that's very difficult because with blockchain technology, it's significantly more complex than your traditional financial system. And there's a lot of technical nuance that people don't understand, which again clouds their ability to see what the real risks are. Does that make sense?
It does. It does. It doesn't answer my question about in 20 years, what's the incentive for anybody to maintain the ultra beautiful security of the Bitcoin network? You know what I mean?
So if you understand the block time, the amount of time that every block is created is fixed by code, at least for now.
Yeah.
And despite people's claims to immutability, there is no code abstraction that's immutable. Everything can be changed because it's essentially consensus-based. It's what people as a community who decide to support that ecosystem decide it's going to be. And if enough of them decide that they're going to fork a new code with a different set of rules, then that's where the value is going to go. And that's right. Something that a lot of investors don't accept. But let's put that aside for a second and understand that if the primary incentive mechanism for miners to secure and process transactions on the Bitcoin network is set to decrease significantly in the future, then you have to assume that the value will go up. That's the only logical assumption that people who believe that can make. There's no other scenario where if the value doesn't go up, that they'll process transactions for free, because they have real world costs that they have to cover, either in electricity, labor, or hardware. So that is a problem that eventually, as an investor in an ecosystem, you have to think about deeply and understand if that's going to mean systemic risk. So what would happen is, if all of a sudden the miners stopped processing transactions, that block time, if there isn't a code change, is going to stay the same. But what would happen is the difficulty of the network would plummet, and other forms of compute could step in and provide that compute. So there's kind of I guess you would call it a shock absorber, where if the network difficulty plummets enough, then it then becomes feasible again for people who don't have the latest ASIC rigs to once again contribute their compute towards hashing. But I don't think that that's a sustainable model. And the reason I don't is because, I mean, everything I've ever studied in my life, things tend to trend towards the lowest energy kind of solution, right? If there's two ways to solve a problem, and one of them takes a significantly less amount of effort, then over time, naturally, people will choose the alternative. They won't pick the one that requires.
I agree 100%.
Right. So the double spend is the primary problem that Bitcoin solves, right? It ensures that everyone agrees and maintains consensus over who has value in the network at all times. And so if there are competing ecosystems that can provide that same function at significantly low amounts of energy and consumption, then naturally value will flow to that system. No matter how much people want it to stay in the system, that's just the natural progression of basically everything. At least that's how I've experienced it. And
that is
effort,
how I
the contrary, kind of builds up this potential. It's like you pull on an elastic band and eventually it will snap. And that's, I think, the situation we'll see for Bitcoin for a while. I actually do think Bitcoin's going to appreciate significantly.
So do I.
Yeah,
I agree.
Yeah. I mean, I think on the learning curve for investors, Bitcoin is the first. It has that network effect, that first mover brand advantage, and people naturally gravitate to it. But as people in the space quickly realize the technical limitations and they dive deep into what the real counterparty risks are, then I think they'll understand the costs and risks associated with it, and that's when we have this migration towards alternatives. So.
And I did that.
Did that answer your question?
I did. I was one. So just for you to have a little bit of background on me, I got into the digital asset space at the end of January 2018. Didn't put any money in initially, just kind of was, leaning in. Put a little bit of money in, so I had just a little skin in the game, and then really started studying. And it took me about three months of like every day, a couple of hours every day, just obsessed with this new thing, till I came up with exactly what you just talked about. I saw what Bitcoin had going on. I loved it. The security and the trust element of Bitcoin, I think, was revolutionary to me. The displacement of these counterparties, being able to just completely eliminate them and have all the trust and security and even more trust and security actually than they provided, is provided in these new networks, right? And then I found the XRP ledger, and I was like, wow. It really blew my mind. I don't know how knowledgeable you are about Ripple, about the XRP ledger, the XRP token, the token economics, the consensus network that they've created. I'm not sure, because it's completely different than Bitcoin, but very similar. You know what I mean?
Yeah, I'm a huge proponent of the XRP ledger and the the Ripple consensus ledger as originally termed,
right?
Precisely because of what we were just talking about.
Me too. I found it. I said, this is it. This is it. I mean, as far as what was available in space at the time, and so far it's held up. It's still, to me, it. Not that I don't like Bitcoin, not that I don't love Ethereum, not that I don't love 5 or 6 or 7 other projects that I think are doing really wonderful stuff. But as far as the it's the XRP ledger for me right now until something comes along that's better.
Yeah, I think for the particular functions that it hopes to solve, I 100% agree with you. I think that it's strategically positioned that it's the most efficient to solving the double span and being able to transfer value. But I would caution people to think that there's still counterparty risk that has to be understood. And I think that's the main hammer that people who support Bitcoin maximalism, they like to hammer on the fact that there is a large counterparty who's a holder of large sums of it, right? And they point to that as, okay, that's a vulnerability that if they wanted to depress the market or extract value from the market over a long period of time, they can do that, and therefore it will never appreciate in value. So as an investor, you need to stay away from it because.
Hang on a second. Time out.
Yeah.
Are you talking about Ripple having a large amount of XRP?
Yeah, I mean, it could be Ripple. It could be any whale who has a large amount of it in a wallet. But that's true with any digital asset, right? So that in itself is not, I think,
that's a misconception. That's something that tells me they don't know that much about it.
I agree. In terms of how they manage escrow and
exactly.
Sure.
It's cryptographically secured escrow. Nothing anybody could do. God could descend from the heavens and demand Ripple open up those escrow accounts. And if it's not on the first of the month, it's not going to happen. You know what I mean? It's it's $1 billion a month, period. There's nothing anybody could do about it. So that whole argument doesn't hold any water. It just tells me they don't know enough about what's been implemented to safeguard the ecosystem to understand. And that's totally cool. I get it.
Right, and I 100% agree with that. It's a matter, again, is that learning curve, is understanding the nuances of who your counterparties are and to what extent, and that's really how you identify the risk. I also think some people have a very difficult time with the distribution mechanisms, whether somebody pre-mined, or if you want to use that term, or in the case of Bitcoin, first adopters who had access to basically very low compute and difficulty curves, they could accumulate vast amounts of Bitcoin, which is effectively a kind of pre-mine. But this is my whole point about when you're looking at the digital asset space as an investor or a participant and you're trying to launch a business into it, is a process for identifying those risks, who the counterparties are, and then itemizing them rationally so that you can plan and make informed decisions. And that's the path I've been on ever since. That any ecosystem I look at, I first try to define what problem are they trying to solve, how are they going to execute, what their team is, who are the people implementing it, the pedigree of their team, do they have anything unique in their technology, how do they compare to their competitors, and you start building a framework. And really, honestly, the last thing that you look at it is the price, because oftentimes the price is a distraction. And as you know, in this market, there's too much manipulation to rely on the price as an indicator of the value. I think the value is very different than the price.
Well, I couldn't agree more. And the truth of the matter is that there's a paradigm in place in digital assets that we've never seen before in capital markets. Therefore, trying to take traditional value metrics, right, and assign valuations to these things that have never been before. We got a taste of it with the creation of the internet, with TCP, SMSP, all these protocols that changed everything. However, those protocols weren't democratized. I don't mean democratized, that's not the word I meant, monetized. You know what I mean? But here we have this whole, now with blockchain, right? Here we have this whole new world of protocols that are going to be pervasive through industries that we haven't even really thought of yet, but are definitely into industries that we, have pain points already. Payments, supply chain management. These are just a couple of the, existing industries that the blockchain is in right now. And we now have a way to evaluate that protocol in the form of the use token that is used in the protocol. But we've never had that dynamic in capital markets before. So assigning a value is difficult. So price discovery is difficult. So I agree 100%. Price is a distraction. The value is in the protocol. And eventually, I believe, the market will be big enough. And then all the metrics, all the dynamics that come into play for markets valuing things will then come into play.
Yes, I totally agree. And it begs the next point I would say is, interledger protocol. To me, that's what I'm most bullish on.
Thank you, Ripple, for gifting that to the world for free, for nothing.
I mean, that to me is the end all be all revolutionary conceptual step. It may not be technologically the end all because, we're going to keep innovating, but.
Oh, absolutely. What iteration will be 5 years from now? Who knows?
Right. Because if each one of these ecosystems is hedge against some counterparty risk, and it's going to vary depending on the use case. If each one is a hedge on risk, essentially, then what happens is interledger protocol allows you to bridge your hedges across a whole spectrum of industries, across a whole spectrum of value transfer. That to me is revolutionary. That's fundamental. That changes how humans are going to interact for forever if we can continue to use it. So to me, I'm more bullish on interledger protocol than even XRP because
sure.
Once
absolutely.
things start connecting and the bridges start getting built, you're going to see a whole cascade of businesses starting to build their infrastructure on top. And it's the first businesses that build their infrastructure. Those will be the new Googles and Apples and Amazons of the world, is the ones who start building on this layer, because the FANGs or whatnot are the internet's layer, the internet of information. But the companies that build on the internet of value, to me, are going to be the next trillion-dollar companies. And I think 10 years from now, we'll look back and realize how transformational this technology is. I think it's even more transformational than the internet of information, personally.
I absolutely love your optimism. I really do. And I'll tell you, I just had this thought. It's a kooky thought, just came into my head. But I was thinking to myself, Santiago is the kind of guy that I would love to have him and 3 or 4 other guys, similar, forward-thinking, open-minded, but yet analytical minds, and sit down at a table for dinner once a month to shoot these things back and forth with. You know what I mean? You're just I think that's maybe that's a different way of me saying you've impressed me as a human being and as a mind. I am absolutely ecstatic that you're in the space and contributing your brain power to the direction and the innovation that's happening in this space and for the greater humanity as a whole, right?
I appreciate that. Thank you.
Yeah. Thank you, man. I really, really, really dig your time. I'm looking down at the clock. This hour has just flown by. Really. And so I'm left with asking, would you be open to getting together in a couple of months and having another discussion or maybe 6 months? And I really like to check in with Block Digital and, that type of stuff, kind of just get a progress report on what's going on with Santiago.
Absolutely. Without a doubt. It was a real pleasure. I really appreciate it.
Right on. So there it was, folks. You're going to be able to find Santiago on both his LinkedIn page and his Twitter. They'll be down in the video description below us here. And until next time, everybody, Pura Vida from Costa Rica. Ciao.
Thank you very much.